Always enjoy this event every year, and the quality of presenters and pitches so far has been phenomenal. So thanks for letting me join. I'm going to be pitching Consortium, and I can start whenever you guys are ready.
Yeah, go ahead.
Great. So the I guess I'll back up and talk a little bit about Greystone. So my name's Adam Wilk. I'm the founder and portfolio manager of Greystone Capital Management. The firm was founded in 2019, and the sort of pitch book description is that it's a long-only equity-focused RIA that utilizes a fundamental research process that's focused on identifying mispriced small and micro-cap securities. And client portfolios are invested in a concentrated way, where we typically own between 10 and 15 stocks at one time, depending on the opportunity set. And I have a really non-traditional background. I started my career in the sports world, actually working in professional basketball for a number of different NBA teams in a scouting and operations role, or scouting and operations roles over the course of a number of years. And made a pretty hard career pivot about a decade or so ago when I was introduced to value investing, and was every bit bitten by the bug, as they say, and I've kind of gone down a crazy rabbit hole, I guess, since that time period. And while I was, I guess, learning how to invest and exploring the industry and trying to figure out how to sort of make my mark in terms of a career, I sort of always knew I wanted to end up on my own, but I spent an inordinate amount of time meeting with investment managers, wealth managers, financial advisors, fund managers, and trying to determine, I guess, how many of these people or which group of these people were setting themselves up for long-term investment success. And that process was based on interviews and conversations and passing notes along, and lunches and drinks and all that kind of stuff. And I basically walked away from that sort of multi-year period with the understanding of, I guess, how I wanted to build an investment firm. And I wanted to do so in a way that was differentiated from some of the larger firms and funds out there. And at a high level, some of those differentiators include being a one-person investment committee. I'm the sole portfolio manager and analyst. At some point, that will probably change due to the research bottleneck, but there's no investment committee. There's no sort of process weighing down decisions, and I can kind of move with, I guess, be a little bit more nimble and quick. Well, like I mentioned, client portfolios are invested in a concentrated way, owning between, this says 9 to 12, but it's about 10 to 15 stocks, depending on the opportunity set, with the top 5 ideas making up probably 60 to 70% of client portfolios. I'm really only focused on best ideas only, so I really want to base the process around deep fundamental research, getting very familiar with the businesses that I'm industries that I'm interested in, and then weighting those positions appropriately to have maximum portfolio benefit. And then going along with the concentration, really try to avoid diversification. I think everybody knows the sort of claim that you achieve as much diversification as you need after maybe about 20 stocks. And so I try to sort of stay a little bit below that area. And then the reason I'm here is because I love investing in small companies, and had some success very early on in my career in microcaps, and was sort of bitten by the bug in terms of that market cap size, and have just kind of fallen in love with the opportunity set. And the plan is to sort of cap assets at a certain level in order to preserve that opportunity set, which I believe gives people like myself a tremendous advantage, as everybody knows the benefits of investing in microcaps. And lastly, and most importantly, the portfolio manager and founder is incredibly aligned with all of the people who have provided capital to the firm, meaning 95% of my investable assets are in the strategy and always will be. And then touching on a little bit more about differentiation, don't have to read each one of these, but I came to sort of understand that not always, but AUM size can be an impediment to investment performance. And so, as I mentioned, my plan is to sort of cap assets over time to preserve a lot of the strategy elements that I think work in my favor. I tried to set up my environment to be really advantageous for picking stocks and doing research. The majority of my days are spent managing the current portfolio, but also looking for new ideas. There's very limited calls, meetings, or things that sort of get in the way of that, which I view as sort of research as being sort of the highest value add activities in investing. And there are calls and things with other investors and industry calls and expert calls and all that stuff, but that's sort of by choice, and that kind of adds to I consider that part of the research process. And then having the ability to invest anywhere, I think, is really important. The idea funnel, I think, is pretty wide, and I have things that I'm comfortable with and certain industries I avoid, but being able to look at any opportunity at any size in any industry, I think, is advantageous, assuming I can get comfortable with those opportunities. And that just really offers a lot more flexibility, I think, as a whole. The strategy is fairly simple. As I mentioned, some of these aspects, it starts with idea generation and identifying small and microcap securities. There's a pretty, as I mentioned, a wide funnel. I try to turn over a lot of rocks. Over the years, obviously, you become more familiar with certain industries and businesses, and pattern recognition grows with experience. And so opportunities can be a little bit easier to filter through or say no to, I guess I should say. And so I really try to turn over a lot of rocks, and then over the years have built up a nice watch list of businesses that I've either owned before or have looked at but haven't owned, or where the price maybe got in the way or there's something missing. And so that provides a nice opportunity to sort of filter through those over time, and make sure I'm kind of hitting on or keeping up with those businesses and in the search for potential ideas. And then once I've found an idea, I kind of run it through my fundamental research process, which I won't get into in depth here, but it's really centered around developing a really strong understanding of the company, the management team, the industry, and then also trying to find some sort of maybe differentiated insight about the business that maybe isn't priced into the stock. And a lot of times in microcaps, nothing is priced in because no one's looking. And so that's one of the aspects I like the most, where you can have an opportunity to get really close to the management teams and really sort of wade in without competition and do your work and uncover those differentiated insights over time that nobody's finding or hasn't, I guess, found up to that point. And then at the end of all of that, assuming a company makes it that far, I'm really trying to sort of combine all of that work into a decision. If there is one to be made where a company may make it into the portfolio with an extreme focus on downside protection, how much you lose if I'm wrong, and a continuous sort of evaluation of the opportunity. Client portfolios typically hold two types of investments: core and special situations. The special situations are pretty self-explanatory. That could be anything from management changes, refinancings or recaps, post-bankruptcy stuff, getting kicked out of an index, anything along those lines that there's a good company or maybe something attractive, but there's an element to it or some hair on it that provides an opportunity for a favorable entry point. Those are typically sized a little bit lower and usually have a catalyst involved, I guess, due to the higher level of risk. And then core investments, pretty self-explanatory. Those are the sort of longer-term holding, better businesses, cash generative, better management teams. And those are the ones that usually provide significant opportunities over a multi-year time horizon. However, lately I have been finding a lot of special situations that I believe could turn into core investments, and those can be very attractive as well. Some of the boxes that I try to check at a high level, really focused on management. That's probably the most important thing in microcaps. They can drive a lot of the opportunity set. And then I really want strong unit economics, whether it's a retail concept or service business or a business-to-business company. And then the valuation obviously has to be very favorable. I won't read through all of these, but this is sort of the high-level investment checklist of mine. And if I check a lot of these boxes, I can usually move forward. And the research framework, once I decide to move forward, is centered around three things. I won't read this in depth, but in line with the unit economics, really trying to uncover a strong competitive position. Management should probably be first here, but really want to know who we're invested alongside and develop a relationship with the management team. They have to have open lines of communication, and I really favor owner operators. A large portion of client portfolios are invested behind management teams who own a lot of stock relative to their cash compensation. And then, as mentioned, valuation. And then lastly, assuming a company makes it this far, depending on the risk reward, the asymmetry, the downside protection, core positions could get anywhere between 8 to 15% position sizes. And I'll sometimes let those run if the stock is working or the business is continuing to execute. And then special situations are usually in that 3 to 5 to 6% range, depending again on the opportunity set and risk reward. But really want to approach sort of the investment process as a, I don't want to say private business owner because we're in the public markets, but as somebody who is less concerned with maybe volatility and the stock price in the short term and more concerned with the actual business execution and what's taking place at the business level. And for more information, you can visit my website, look at the end of the pitch book to contact me, greystonevalue.com. So today I'm going to be talking about a stock in the cannabis universe. It's a pretty hated area right now and a really interesting one in my view. I've been doing a lot of work in the space and have come across some really cheap and interesting opportunities. Here's a little overview of the business. A market cap of 62 million, net debt of 56 million, and then an enterprise value, which I included here, the cash from outstanding options and warrants, which is a little misleading, but without those, I think the enterprise value would be around 110 million. Management is guiding for 90 to 95 billion in revenues this year, which is up from 65 last year, and EBITDA of 20 to 25 million, adjusted EBITDA of 20 to 25 million, which is up from 19 last year. And so valuation at the midpoint of that guidance this year would come in at under 5 times at about 4.5. Put simply, I think the opportunity exists here, number one, because this is a microcap. There is one analyst covering the name. It's more of a general cannabis analyst and not company specific, so there's really no analyst coverage. The company is very small and therefore liquid, and this is a bit of a turnaround story. And then add in the regulatory stuff. Cannabis is still federally illegal. There's a lack of capital in the space, and sentiment is probably at an all-time low right now, following the sort of bubble from 2018 to 2020. And this last year has been really brutal for the industry itself and all of these stocks as people sort of do this dance with regulation. And before I get into the actual business, that's part of the reason why I like this space, is because the stocks don't really trade in line with like broader economic news. Obviously, consumer-based businesses are affected by high inflation and things of that nature, but there's a really sort of uncorrelated element here where a lot of these stocks and the industry itself sort of trade on regulatory news, and so they can provide a little bit of sort of a buffer to whatever else is going on out there, which is kind of what I like about the space right now and how I've sort of sized these in client portfolios. I've taken a little bit of a bucket approach, although among that or within that bucket, Consortium is the largest position because I think the opportunity set is very interesting. So at a high level, the Consortium is a cannabis stock, and it is one of the fastest growing, most profitable, and highest margin, cheapest cannabis stocks in the entire universe. The business is at an inflection point right now where I think a rapid increase in revenues and EBITDA is set to take place. The last 2 quarters, Q1 of 22 and Q2, have been record quarters, and the stock has barely moved. And there's been very little reaction to that. And the stock currently trades for less than 4.5 times this year's EBITDA and less than 3 times my estimate of next year's. And I think there's a really strong growth runway in front of the business and very attractive takeout potential. Um, the company produces and sells medical cannabis in the Florida market primarily. The core market is the state of Florida, where they are vertically integrated and they engage in cultivation, processing, retail, and distribution of cannabis. They have a number of different products, basically everything you can imagine in their retail shop, whether it's edibles, flower, vape products, cartridges, etc. And they provide their products under the Fluent brand name. And the company is actually in the process of changing the business name to Fluent. So that should take place, I believe, by the end of the year. As of the last quarter, Q2, they operated 27 dispensaries in Florida, 3 in Pennsylvania, and then they have one. They exited their grow operations in Michigan recently, and they have 1 retail dispensary and grow operation in Texas, which is kind of not meaningful from a revenue or EBITDA standpoint. The business model is very simple. Cultivate, grow, process cannabis, and then sell it via their retail dispensary network to medical patients in the state. As I mentioned, they are a bit of a turnaround story. There's been significant operational and financial improvements since 2019, including burdensome capital raises that were dilutive, expanding their cultivation network, inventory improvements, management changes, and actually avoiding insolvency while they were trying to build out their dispensary network. These improvements are behind them now, and the company, the fundamentals have significantly improved, and so has their market share, and they have an incredibly large opportunity in front of them to sort of continue growing that. As you can see here now, this slide says number 7, but they have the number 6 position in the state in terms of their ounces of flower sold and their retail dispensary network. Florida is responsible for about 85% of revenues today and around 100% of EBITDA. And revenues are, in my view, could grow above 25-30% into the foreseeable future, with EBITDA coming in the 15 to 20% range in terms of growth. Management strategy from here includes moving from that number 6 position to number 3 by continuing to increase their cultivation footprint, maximizing their current store base to grow their market share, and then continuing to grow their dispensary count. One of the interesting things about their guidance is that the additional dispensaries that are already under construction, I think 4 or 5 by the end of this year in Florida, are not factored into that guidance and will be very accretive or additive, I should say, from a top line and EBITDA perspective, with very favorable unit economics and pretty quick ramp times. You'll notice the debt picture, which I won't get into in too much detail. Market cap 60 some million, the debt outstanding, net debt is 56. It's been a little bit burdensome on the company over the years to try to get to where they are now. This is probably the most favorable position they've been in from a capital structure standpoint. And the interest expense is also a little bit burdensome. Unfortunately, that's sort of the state of financing in the industry, and there aren't many great options for refinancing at this stage. The debt matures in 2025. The interest is 13%. But the company is talking with a number of businesses, a number of family offices and capital providers to see what they can do in terms of providing more flexibility or growth capital. Having said that, they are free cash flow positive for the first time in their history as of Q1. And so they're self-funding. Growth CapEx and maintenance CapEx needs are fairly low, even with the dispensary build-outs. And so, and they also have entered into favorable leases where the capital providers for the buildings will actually provide them with the construction. And so the capital needs are pretty minimal up front. And so free cash flow should more than cover any expansion and also be able to sort of continue paying that interest expense. As mentioned, the valuation is very low. Here's a few financial highlights. As I mentioned, the top line growth. They're finally EBITDA and free cash flow positive. And the inflection point here just sort of illustrates, I didn't show previous quarters, but sort of illustrates the growth that you're seeing over the last 2 quarters in terms of revenues and adjusted EBITDA, which makes me think that the guidance for this year, although Q3 is a bit seasonal, could prove conservative, and the company could definitely exceed those EBITDA targets. A quick glance at this peer table indicates that Consortium is, as I mentioned, one of the fastest growing and cheapest cannabis stocks. I'm happy to share this in further detail once I'm finished. And in terms of valuation, as I mentioned, valuing the Florida operations on next year's EBITDA at about 6.5 times, which is still below the industry, below all their peers, ones that are growing slower and with lower margins. That would result in a significantly higher share price than 20 cents today. And those estimates, as I mentioned, just include Florida operations alone and exclude any incremental EBITDA from Pennsylvania and potential license value for Pennsylvania or Texas if they decide to try to monetize those for capital. One thing I haven't gotten into in too much detail is that Texas is an incredibly restrictive state, one of the most in the country, if not the most. And Consortium is one of only 3 license holders in the entire state. Obviously, if favorable regulation were to pass, Texas would be an enormous market for both medical and adult use. And a company like Consortium would significantly benefit from that, but also could monetize their license over time should they decide not to expand in the state. And I would estimate, based on industry conversations and research, that the value of that license is probably worth in excess of the entire market cap, taken with a grain of salt, but providing some downside protection. And any changes to regulation would obviously provide a huge tailwind for the entire industry, Consortium as well. By allowing capital to come into the space, lowering interest expense, getting rid of the burdensome tax regulations, and sort of allowing and increasing adult use in the state of Florida. Lastly, the company would serve as a pretty strong acquisition target for a larger operator or a strategic trying to either enter into Florida or expand their geographic presence. Consortium is 1 or 2 dispensaries behind the number 3 or 4 largest operator. The number 5 largest operator, and maybe 8 or 10 behind the number 3 or 4 largest operators. And so, at their current scale, run rate, everything, I think it would be very accretive to a larger operator. And then here's some catalysts, and happy to share this with anybody who's interested or take any questions as well.